Recent indicators point to a slowdown in China at a time the US recovery is looking tentative and Europe continues to wobble over the Greek debt crisis. The bearish momentum on China gathers steam. Investors are starting to factor in the risk of hard landing in the world's fastest growing emerging market.
Hedge funds are shorting China, not only in equities, but in the currency market. They're now betting against the yuan, trends that bears say portend a hard landing in China.
The property bubble collapses, consumption gets hit, investment gets hit because no one's building apartments anymore, the banks go bankrupt because they have all these new NPLs out there, and then money begins to leave China.
Money leaving China is something investor Mark Faber is wary about. While he isn't sure whether China's economy will end up with a hard landing, he's advising investors to expect the worst.
Some countries export more to China than to the US or to other parts of the world, such as Australia, Brazil and Canada.
Stanchart, though, is of the opinion a hard landing isn't imminent. And of all the tools available to the government, devaluing the yuan is the last option.
There are a ton of other things you could do before you did that. You could authorize more infrastructure projects. You could lower interest rates, lower the reserve requirements, pump more money from the budget into the economy. You could even, if you're concerned about your exports, you could reduce the taxes that the exporters pay.
Engineering a soft landing for China is in everybody's interest. With the overhang of the Greek debt crisis and fiscal woes in the U.S., the last thing investors need now is a messy ending to what's been a remarkable growth story in China. For ET Now, Kathy Yang, Reuters TV, Hong Kong.